Starting recording. Yeah, hi everyone. Today we have Gautam Baid with us. He's a fund manager for Stellar Wealth, and he has been. I'll just read his profile to you. He's the fund manager of Stellar Wealth Partners, a Delaware investment partnership company modeled after Warren Buffett partnership fee structure. Okay, the fund is available to accredited investors in the US and invests in listed Indian equities with a long-term fundamental and value-oriented approach. Okay, fundamental and value-oriented. Gautam is also the founder of Stellar Wealth Partners Private Limited, a SEBI-registered research-related firm which offers small cases for investors in India. Okay, previously Gautam has served as a portfolio manager at Summit Global Investments, a SEC registered investment advisor based in Salt Lake City, USA. Before that, he served at the Mumbai, London, and Hong Kong offices of Citigroup. My God, Deutsche Bank as a senior analyst in their investment banking teams. Okay, now he is also the author of Joys of Compounding book. We have read that book. And he's a CFA charter holder and member of CFA Institute USA, MBA in finance from Nirma University, India, and MS in finance from ICFI University in India. So many credits to you already. Okay, so we decided to talk to him because we all know we are in a bear market. Okay, yesterday the market, yesterday meaning 28th of February, market was more into decline and less for advances. Today the market has opened in green in India. Okay, so not taking much of your time, Gautam. Thank you for joining us. And I know it's night there. You have to wrap up your day. Okay. So, okay, I'll start the first question is that, we are in a bear market, as you said. So how long do you think would it last? And because we all have been talking about recession, and now even India is slowly getting into, because the margins are being hit of the companies after the Q3 results. And slowly it is showing the impact. So where do you say we are headed?
So the answer to your question lies in the interest rate cycle, because interest rates at the end of the day act as a force of gravity for equity valuations. And any good investor needs to be an ardent student of financial market history.
Yes.
And history teaches us that when interest rates are rising, the equity indices, the frontline indices may be range bound, but bottom-up stock pickers can still make a lot of money. Yeah. But we have many cases in the past when the frontline indices basically went nowhere for many years, but individual stocks did very well. As an example, between January 2008 and June 2013, for 5.5 years, the Sensex basically gave zero returns for 5.5 years. But if you invested in the great businesses like HDFC Bank, ITC, Titan, you could have still made a lot of money over those 5.5 years.
Yes.
And if you also look at the US market, for example, there the example is even more extreme. Between December 31st, 1964 to December 31st, 1981, in 17 long years, the Dow Jones advanced from 974 to 975. One single point move.
Oh my God. Okay.
But Warren Buffett compounded his money at over 20% for those 17 years when the Dow basically gives zero return. So at the end of the day, it'll all boil down to bottom-up stock picking. It's no doubt that we are in a bear market right now because of liquidity tightening and rising interest rates.
Yeah.
So the only mantra that will work in this kind of a market is chase sectors and stocks with earnings growth visibility for the next 2-3 years. There's no other way to make money in such kind of markets.
Oh, so yeah, it's mean that cherry picking the stocks, because even I tell my clients that if you cherry pick stocks, you can even make money in this market also. Like since last year, also many of the stocks have made money. They've hit 52-week highs also, but overall the market is bearish. Okay, now should the investors keep investing abhi, or should they wait because the market dips? So they think that, oh, now I can enter. But what happens when it dips further? So then they feel, oh my God, what is this? And as an advisor also, like, they start calling me. So I'm a franchisee for IIFL Security. So I make people's portfolio. So then they are like, oh, ma'am, aapne to yahan karwa diya, ab ye to gir gaya stock and all that. So should they wait or should they invest?
If you wait for clarity, then you will have to pay high prices for clarity. And in the
Mm.
stock markets, you often pay a very high price for a cheery consensus. Good news and good prices never come together in the stock market. But the
Oh.
greatest investment opportunities come when there is a big macro fear and stocks of both good businesses and businesses, everything falls at the same time. During
Mm.
periods of panic and fear, the markets are unable to differentiate between good and bad businesses, and all the stocks fall. That is the time to actually make use of this inefficiency in the market and actually increase your holding of the good quality businesses. And it's very, very important to understand that stock market returns do not come in a linear manner. They
Mm.
come in a bunched up manner during periodic pockets of strength. And the biggest gains from the stock market often come just coming out of a bear market low.
Yeah,
You know,
correct.
initial, that
True.
initial sharp rally just off a bear market bottom is when the fastest pace of wealth creation happens in the stock market. So if an investor is out of the market at that particular time, he would
Mm.
lose on the bulk of the gains. So the only way to truly make big money in the stock market is to remain invested in the market with a good portfolio over the long run, and you have to withstand the ups and downs of the markets. All of us can take the ups, but you should also be able to take the downs. And the only way you'll be able to sustain all the downside volatility which keeps coming in the stock market is when you have a good portfolio. Because if the earnings growth is going up and the stock price is going down, then you can sleep peacefully at night knowing that eventually stock prices will catch up with earnings. But if the fundamentals of your businesses are deteriorating, then there
Yeah,
is a problem,
yeah,
because then stock prices are falling for a justified reason.
yeah.
So, just you have to differentiate when the market is acting foolishly versus when the market is acting very smartly.
Yeah. Okay. Now, for a very common person, for a layman, what is the tip that you would want to give? Because see, as an advisor, as someone who's into in some investment firm or something, you have all the access to data and information from everywhere. Now, for a lay person who has some time to invest in market, now how does that person cherry pick? Because even in such market, even ITCs are falling, even HULs are falling, even big IT companies are falling. So big names that we generally chase are falling. So how does a lay person pick? What is the tip that you would want to give them?
First of all, I would say the lay person or the retail investor should not follow tips, because I often tell people that if you follow a tip, you will fall into a pit. So don't follow tips.
follow,
Just
follow your
do
advisor.
solid research, and backed by get good advice backed by solid research from a SEBI registered research analyst or investment advisor or a PMS firm.
Mm, mm,
And if you cannot do the research yourself, then start off by investing in an index fund. A low cost index fund is good start. After
mm.
that, you get to actively manage mutual funds. Then you can look at a small case, and then you can look at a PMS, and then you can look at investing in stocks directly. But there has to be a particular progression for a
Yeah,
layperson to
yeah.
approach the market. This is a place where, unless you know the ins and out of a company, and unless you know how to do proper fundamental analysis, you should ideally leave it to the experienced people in the business. No, when you fall sick, you don't try to cure yourself. You actually go to a qualified doctor. You're
Mm,
facing a legal problem. You don't try to solve it yourself. You go to a qualified lawyer. Similarly, if you want to look for good investing returns, look for a experienced professional and keep learning along the way. There is no harm in doing direct investing yourself, but you have to start learning how to analyze businesses first, and then
mm.
only you should put your hard-earned savings into the stock market.
Yeah. Okay. Now there's a lot of negative commentary on economy that we are entering in a bear market. That was earlier for US and Europe, and India was seen as the shining star. Now even India, like since last 1 month, even now India is gradually slowing down the growth. Inflation figures were higher than the last 3 months. 6.5 it was okay, and also the demand is coming down. So now what should retail investors do? Because now some people who have money, okay, money is like, we generally know retail investors don't have that much money. So thoda sa bhi that paisa, where should they put? You on mute.
So in a range bound market or in a bear market where the indices are not going anywhere and there is a deluge of bad news coming at you from all quarters,
Yes.
only strategy which works in such kind of a market is to invest in stocks and sectors with earnings growth visibility for the next 2-3 years, because such kind of markets become very very narrow.
Yeah.
And
True.
when liquidity is tight, that limited capital will chase pockets of growth, the few hand select pockets of growth where visibility of earnings are there. The investors will chase those stocks only. So you have to just very very carefully select your spots and
Hmm.
invest in companies with good earnings growth. And number two, this is the time to actually not stop your SIPs. This is the time to actually bump up your
Yeah.
SIPs. I was reading a data that more than 38 lakh investors have left the stock market in the last 6 months because of the
Hmm.
negative returns from small cap and mid caps.
True. True.
This is called behavior gap. So basically, investors chase the most recent outperforming stock sector or fund manager, and
Hmm.
then once that particular stock or sector or fund manager starts underperforming, then they leave that particular
Yes.
investment
Yes.
and then they chase the next outperforming, group of stocks or sectors
True.
or fund
True.
managers. But this is a recipe for long-term underperformance, because there is one iron rule in the world of finance, which is mean reversion. So periods of outperformance will be followed by periods of underperformance and vice versa. So you have to basically just take all the ups and downs, right through all the volatility, and focus on the investment philosophy of your
Hmm.
financial advisor or the fund manager in whose scheme you're basically investing. And if you're investing yourself, be mindful of the fact that once you have an investment philosophy set in place, then follow it for the long run. An investment philosophy is not something that is available next door. It is something that is built up over a long period of time. And
Yeah.
discipline is the
Yes.
price to be paid for short-term underperformance. The solution is not to keep changing the strategy every time the strategy stops working, because no strategy will work 100% of the time every single year.
Yeah.
So 2018-19 and early parts of 2020, buy at any price, buying high quality businesses at any price, that strategy was working very well for those
Yes.
2 years and a
Yeah.
quarter of it.
Hmm.
But in the last 2 years, I mean, during the rising interest rate environment, the PMS managers or the fund houses following buy at any price strategy, they are underperforming. Once interest rates start falling, again those strategies will start doing well. So all these ups and downs, positive years, positive return years, negative return years are all a routine part of the investing game. The key is you have to be present in this game for a long time in
Hmm.
order to be able to win it.
Yeah, so patience is the key. Okay, now so this brings me to my next question, which is that uh, like uh, the big money, like Charlie Munger said, that the big money is not in buying and selling, but in waiting. Okay, so how do investors know which stock to buy and hold and which to sell in such a market? Because as I said earlier also, that even people are now selling IT stocks. In fact, some have completely removed them from their portfolio. Like I was telling them, keep some, at least keep some big names or whatever, and some which have good fundamentals and good quarter earnings over some few years, but still panic and all that. So what is your suggestion?
So have the most patience with great management teams operating in secular growth industries, because
Mhm.
such managements are often able to pivot into
Yes.
adjacent areas,
Yeah.
create extra value for shareholders. For example, not a stock recommendation, and we do not hold it in our India fund or small case. Look at Astral Poly, how it pivoted into adhesives from being
Yes.
in
True. True.
CVC, PVPC pipes earlier. So once you find a great management team in a secular growth industry, be very patient with them. And number two, if you have found a mid cap or a small cap size business, which is
Mm.
a sector leader and having
True.
a large addressable market
Mm.
opportunity, also be very very patient with such businesses as well. So in these two situations, be very very patient. But in all the other cases, if you're when you're investing in commodities and cyclical businesses, there you focus on price and mean reversion, and
Mm.
basically buy and exit at the appropriate time once the cycle starts turning again. But in the two cases which I mentioned earlier, you should
Mm.
be very patient, and periodically those stocks will become very expensive. They will undergo time correction.
Mm.
But story of any long-term compounder, if you look at HDFC Bank, for example, great
Yeah.
long-term compounder, but
Yes.
for the last
Yes.
2 years, because of the merger overhang with HDFC
Yes.
Limited, the stock is not going anywhere. Similarly, Titan, there has been many 5-year periods over
Yes,
the last,
yes,
even
yes.
Titan also gave no returns. So, you have to be very, very patient when you find a great business being led by a great management.
Yeah, I like these two examples, because these two are, generally they have been in good portfolios, even with MFs, but since they were not moving at all, and this HDFC merger thing created a lot of fuss. So many of my clients also sold HDFC, and then if you have been noticing, of course you would have been, it was somewhere down. Now it has again started climbing, HDFC Bank especially. Okay, so as a value investor, can you explain the margin of safety and how investors should think about margin of safety?
Margin of safety simply means that you're buying a stock of a business for less than what it is worth. And
Mm.
the margin of safety comes not only from the intrinsic value, but also from the quality of the business and the quality of the management. Now, I often
Yes.
tell people that to assess the margin of safety, you don't have to carry out a detailed discounted cash flow analysis on a spreadsheet. You just need to have a discounted cash flow mindset, being
Mm.
able to focus on drivers of terminal value, because that is what drives P ratio re-rating and P ratio de-rating. Investing at the end of the day
Yes.
is all about
Yes.
terminal value, because 70 to 80% of a business's intrinsic value lies in the terminal value. So it is the perception among investors regarding the riskiness of the cash flows of a business, which in turn determines the discount rate which investors use to value the business, and that in turn determines the valuation multiple. This is the holy grail of valuation. If the business model is becoming less riskier, your
True.
discount rate will go down, valuation multiple will go up. And if the business model is becoming more riskier, then the discount rate will go up and the valuation multiple will come down. So think like a business analyst, not like a securities analyst.
Okay. Right now, okay, for a retail person, leave it on your advisor. If you can't do so much of analysis and all that. Okay. Which sectors in India are you bullish on? Because this is a question which everyone is asking every day. Even fund manager are asking each other, because some are still bullish on IT, mid cap IT. Most of them were bullish on banking. Now even they are saying that okay, now we are over invested in banking. So now look, it's like everywhere. So it's like a rotation which is happening in the market. So which sectors are you bullish on?
This is a good question, and this is something which all investors should keep in mind, especially during a bear market, because sectors with earnings growth are the ones which will deliver alpha to you. So I'm very bullish on private sector banks. There
Okay.
are many reasons for this. We all know that that during a rising interest rate environment,
Hmm.
banks experience net interest margin expansion because the deposits are repriced more slowly than
Hmm.
the loans, than the rate at which the loans are repriced. Number two, asset quality is sharply improving, and many of these banks had done over provisioning during COVID. So now you are having write back of those provisions, which is giving an extra kicker to the net profit after tax.
Yeah.
Also, corporate India over the last decade has greatly delevered its balance sheet, and it's embarking on a fresh round of capex.
Hmm.
That offers very well for lenders, anyways. So, if if there's a manufacturing upcycle, then banks will naturally benefit. The second theme on which I'm very bullish is autos and auto ancillaries, because for the last 2 years we were in a down cycle because of the semiconductor shortage. But
Yes.
now there are talks of a semiconductor glut which is about to take place. At the same time, within autos, just be very careful because rural India is still struggling,
Still
and
struggling. Yes. Two wheelers are
two
struggling.
companies have got a very high exposure to rural India. So those are the areas where I would be very cautious. But commercial vehicles are doing very well, followed by passenger vehicles, and finally you have the three-wheelers and two-wheelers. So that would be my pecking order in auto and auto ancillaries. The third theme on which I am very bullish is domestic manufacturing. In
Hmm.
September 2019, the finance minister cut the tax rate for new manufacturing units to 15%, giving a very big impetus to
Hmm.
domestic manufacturing. That was followed by the production-linked incentive or the PLI,
PLI. Yeah.
is manufacturing firms to become bigger.
Hmm.
And you're also seeing India entering into a lot of free trade agreements with many nations. That also augurs well for manufacturing. And the capacity utilization across many manufacturing companies in India is now approaching 80%.
Hmm.
This is they embark on a fresh round of capex, and I think
Hmm.
manufacturing as a theme is expected to do very well for the next 3-4 years at least.
Okay. And do you believe in this EV story and this new energy thing? So are you also bullish on that?
Electric vehicles are the future. There's no doubt about it.
Hmm.
We don't have too many listed electric two-wheeler players in the Indian stock market, but there are certain auto ancillary companies which
Yes.
are the sole supplier to some of these unlisted electric two-wheeler companies. I think that is where you'll get potential for higher growth. So you have to do your research and pick your pockets very carefully.
Okay. Okay. And okay. So at Stellar Ware Partners, you follow an investment philosophy of variant perception and long-term structural trends. Okay. Can you elaborate on both of these framework?
So variant perception refers to having a differentiated view on the
Yes.
short to medium term on the short to medium term trajectory of a business.
Hmm.
And variant perception refers to situations where you have earnings growth coupled with ROC expansion or return on capital employed expansion. That leads to valuation re-rating, and you
Hmm.
end up with multi-baggers. And there are various triggers for variant perception. Number one, product mix change into a higher margin category because higher margins lead to higher ROC. Number two, deleveraging. As debt goes down, interest cost goes down, net profit goes up, market
Yeah.
cap. Also, as since debt is a part of capital employed, as debt goes down, your capital employed goes down, so your return on
Hmm.
capital employed goes up.
Yeah.
Number three, industry cycle shift. So, as an example, since middle of 2020, the residential real estate cycle in India has turned around after almost a decade, and you have
Yes.
had many multi-baggers coming from the building material space in the last few years. Number four, regulatory change. So in early 2020, the government of India gave a big thrust to ethanol blending, and you
Hmm.
saw you got so many multi-baggers from the sugar mills and distillery space.
Hmm.
Number five, improvement in asset turns. You can get this information from managements on conference calls. You can ask them what is the expected turnover on the new fixed asset capacity. And between high margins and high asset turns, I prefer the latter because high margins tend to attract competition. Apart from these, you also have reduction in working capital cycle. So working capital improvement is another big trigger because if the
Yes.
terms of trade improve, working
Hmm.
capital cycle gets reduced. That frees up your capital and the ROC expands and you get valuation re-rating. That is also a very big trigger for variant perception.
Hmm.
Another trigger for variant perception is cost reduction. So you'll see many companies often set up captive power plants or backward integrate into the raw materials to save on costs. And that backward integration or setting up of that captive power plant, that's cost savings, also lead to a big disproportionate growth in the net profit after tax. So that's another source for variant perception. Finally, we have corporate actions like demergers, promoter
Yeah.
management change, merger
Yes.
arbitrage, and divestiture of a non-core or a loss-making business segment. So there are multiple triggers for variant perception. As far
Hmm.
as structural trends go, these are found in industries with a very favorable structure. They're
Hmm.
organized like a monopoly or a duopoly or an
Hmm.
oligopoly at best, and they are characterized by very high visibility of growth for many years ahead. They have
Hmm.
consistency, predictability of cash flows, and they are also characterized by value migration. So in India, for the last 20 years, we have had value migration from offline to online, public
Hmm.
sector to private sector, unorganized to organized. And
Hmm.
there are multiple structural growth plays in the Indian stock market today, including specialty chemicals with critical application,
Hmm.
affordable housing, contract research and manufacturing services,
Yeah.
electronics manufacturing services, music streaming, fintech, digital transformation.
Yeah. 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 Hmm.
Multiple mega trends are in place. These mega trends will provide you long-term compounding in the portfolio, whereas the
Hmm.
perception plays will help you generate alpha.
Hmm. Okay. Wow. Okay. Okay. Now we'll talk about your book. Okay. Like in your book, The Joy of Compounding, you refer to Warren Buffett's quote that the single most important decision in evaluating a business is the pricing power. Okay. Now, if you got a business where even if you raise prices without losing business to a competitor, I think like Apple was or is, you got a very good business. Okay, now how can investors find businesses with pricing power in the market, in this market?
So in the last 12 months, when we've had very high inflation, a great way to find out companies with pricing power is to look for those companies which were able to increase their gross margins.
Yeah.
High gross margins, in most cases, are a very good indicator of pricing power of a business. So if you look at the US stock markets, for example, many of these software as a service companies have gross
Yeah.
margins as high as 80% and above. That indicates true pricing power. So look for companies which have been able to demonstrate high gross margins and improving gross margins over the last 12 months in the middle of this high inflation environment. And number two, if a business has got pricing power, it will reflect in the terms of trade. So when you open the annual report of a company, go to the footnotes to the accounts and also check the balance sheet to see if there is an item called advances from customers, because that indicates demand pull. And that kind of company generally has got pricing power. So terms of trade
True.
and improving gross margins in an inflation environment, this is how I would identify businesses with pricing power.
Okay, now I think that is in Indian context more seen in the cement, some of the cement stocks, because cement prices have gone up by 10 rupee per kg, and then initially 7 rupees. So I think that, and also it's a part of the capex story, the infra push in the budget which was there, which is the thing of this government. So I think cement stocks, I won't name them. So I think because some of them have consistently done well even in this bear market, I think. Okay. Okay, so you're not commenting on that. Okay, so okay, what are some thumb rules that an investor needs to keep in mind while entering the market, which is already trading at a high P? Indian markets are expensive, we know that. Because of that, also some investors don't enter. They are always like, when I have more money, then I'll invest and all that, because buying 10 stocks or 20 stocks of a company, a good company, doesn't seem or click with them. So they are like, let me accumulate some money and then I'll enter. And accumulating that money, by the time they accumulate, the stock has already run up, or even the market has gone up. So what would you say on this?
So first of all, let me tackle the high P ratio aspect. So in my book, I've talked about this important point, and I've said there is a lot more to making money in the stock market than just looking at P ratios in isolation, because a P ratio does not take into account the management integrity, the management execution capabilities, the cash flow generation, the balance sheet strength, the competitive advantage, the duration of the competitive advantage. Many things are left out by the price to earnings ratio.
Yeah.
Investor who wants to find out the justified or the fair P multiple for any business should read white papers. The first white paper titled "What Does the Price to Earning Multiple Mean" by Michael Mauboussin. And the second white paper they should read is
Okay.
"The Price to Earning Ratio: A User's Manual" by Epoch Investment Partners. Once you read these two white papers, you'll understand that the justified P multiple for any business is driven by only two things: earnings growth and return on invested capital. Businesses with lower returns on capital deserve to trade at a low P multiple, and businesses with high return on invested capital deserve to trade at a high P multiple. All other things, because if a business is earning less than its cost of capital and it tries to grow very fast, then it destroys shareholder value. So for those businesses, they should focus on improving their return on capital employed. On the other hand, for businesses with already high returns on capital, those businesses should focus on improving their revenue growth. That is where the maximum intrinsic value creation, the fastest rate of change takes place. So, you have to understand and segregate the stock market into these two kinds of businesses: companies with low returns on capital, companies with high returns on capital, and then invest accordingly.
Okay. Now I want to take your view on IT stocks, because I still advise some of my clients, some of the IT stocks, of course, cherry picked, but they hear to other managers and they are like, people are getting out of IT stocks. So, what is your take on IT stocks, and should or can they be still invested in? Because of course, most of them have come down, corrected. So now they are a little on a better valuation as they were earlier. So earlier, some stocks were completely out of reach. So now they have corrected a bit. So would you suggest cherry-picked IT stocks still?
So this is again, like I mentioned earlier in this discussion, that any good investor is an ardent student of financial market history. Go back in time and check all the articles on IT industry in India between 2016 and 2017. For those 2 years also, IT sector was completely written off. You were having stocks at very cheap valuation multiples. And eventually, once COVID hit, we had one of the biggest bull markets in IT in 2000 and 2021. As soon as that COVID euphoria basically passed by us, many of the stocks are down 30-40%, even the higher quality businesses. And not only IT stocks, even some select pharmaceutical businesses.
Yeah.
I believe IT and pharma, these are two industries in which India has a global competitive advantage.
True.
So whenever these two industries undergo a downturn or a slowdown and valuation multiples correct excessively,
You can
downside,
add.
that is the time to actually increase your allocation to such industries, because eventually, because of the sheer competitive advantage which India has in these two industries, these two sectors inevitably bounce back. And it is very difficult to lose money if you invest in good businesses from these two industries, because
Yeah.
India, she has a very big advantage compared to the rest of the world where these two industries are concerned. So again, it's not a blanket statement to buy any IT stock or any
Yes.
pharma.
True.
For example, in pharma, you should avoid the US generics
Mm.
businesses, or the companies which are predominantly based in the US, because unbranded generics do not have any pricing power and
Mm.
they're very capex heavy. So those kind of businesses destroy shareholder value. So
Mm.
for companies with good returns on capital and a good pipeline of drugs, and which have got very good management teams. Same thing goes with IT. Uh, you know, the companies which are operating in a particular niche and have got very high expertise in those particular niches. I
True.
think that is where you can invest for the long term and make good amount of money when the valuations are low.
True. Okay. Any take on the new age companies, which were in thing? Everyone was rushing into PB FinTech and Zomato's and LICs. LICs was just recent one. Delivery. So any take on that? These new
All
age
it took
companies.
was 1.5 years of high interest rates and tight liquidity to bring all those managements back to earth and start talking about profitability and a focus on free cash flow. Look at the managements of any new age company now. Into year 2000, 2021, they were all talking about top line growth, top line growth, top line
Yes.
growth. Now
Yes.
all of them are singing the same tune about cash flows, profitability, unit economics.
Mm.
This should have been the focus from the very start, as
Yes.
because
Yes.
they basically wasted so much money on so many excesses during the COVID boom that they'll have a hard time coming out of that. And investors generally, once stocks fall 70-80%, they take a long time to regain investor confidence. So
True.
I don't invest my fund or my small case. We don't have exposure to any new age tech company,
Okay. That
because
says it all.
valuations still don't make sense to me. Some of them are talking about making this quantum of net profit by FY26, FY27, and someone is talking about FY30. No, I would rather focus on businesses which are fairly valued on current year earnings or maximum 1 year ahead earnings, and that gives me a decent margin of safety and allows me to sleep at night. Because if I
Mm.
invest in new age tech business stock and that stock falls, since I do not have any valuation support, I
Mm.
won't be able to add on to my position.
True.
And a good portfolio is one in
True.
which the fall in the stock prices should make you excited to add
Yeah.
more money.
Yes.
That is a good
Yes.
portfolio in which
Yes.
you have valuation support and earnings growth. But in case of new age tech companies, I don't have either of them.
Okay. 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 Any idea or Fed is likely to hike more? It seems. Do you expect the RBI also to hike, because some people are expecting RBI to again tighten some 0.25 BPS. Some are saying that no, RBI is done with hiking. So what's your take? What do you think about it?
It will be determined by the pace of hikes by the Federal Reserve, because at the
Hmm.
end of the day, the RBI also has to defend the rupee.
Yeah.
If the Federal Reserve hikes very aggressively, the RBI will have no option but to follow suit.
True. Okay.
We face some further tightening. Very good time for savers after a long time. Finally, fixed income has become an alternative to equities, and
True.
that in the flows. So you are seeing a lot of flows shifting from equities to fixed income, because
Yes.
finally investors are getting very good returns in fixed income as well. And we have seen in the past, when fixed deposit rates are above 8%, the
Hmm.
equity markets tend to become very, very range bound, because there is always a constant tug of war happening for the flows between fixed income and equities.
Hmm.
And I think the stock markets may remain range bound for the next 1 year or two, but bottom up stock picks can still make you some money.
Hmm.
Investors should temper down the return expectations. It's very important to not anchor to the returns of 2000 and 2021.
True.
Realistic, take the reality, the updated reality into account, and just temper down your return expectations. The time for high returns will come. The
Hmm.
stock market, things, this high return in years do come periodically, but as long as interest rates remain high, we should keep our interest return expectations low, with
Yeah.
the understanding that in the future, once interest rates start getting cut aggressively, we'll
Hmm.
again get a very sustained move in the stock market and make very good money that time.
Hmm. Okay. And last question. Where do you see this real estate rally going? Because after a long time, India is seeing this uptake in reality sales and all that. But now even the interest rates have gone up. no, 6.5 to I think it's around 9% now of home loan rates. So where do you see it? Do you see that stalling this reality rally, or you see it will not impact sales of new houses? Yeah.
By the news headlines in the media in the last few days, luxury real estate in India is booming. I mean, 7 crore,
Yeah.
10 crore priced apartments are selling out in a matter of days. So
Yes.
the upper
But generally, yeah, that is in the premium segment. Yeah. Yeah.
Yeah,
Sorry.
that is not struggling. It is the middle income segment which is struggling right now because of high interest rates. And that's to be expected because if interest rates go up, most of these loans are on floating rate interest. So obviously that will then
True.
demand real estate, residential real estate. So I think again, certain pockets within real estate, like very high end luxury housing will do very well. But middle income housing may struggle for a time for some time. And affordable housing is an evergreen theme. That particular section of society is not that sensitive to interest rates. So I think right now you're having a very extreme polarization in the real estate industry where the bottom end and the top end are doing fine, but the middle income is struggling.
True. Okay, it's like almost in everything, like even in consumer discretionary, in cars, in housing, the premium segment is doing well, and it's the bottom which is struggling. This is the K-shaped recovery which we are into. Okay, thanks a lot, Gautam, for joining us and answering so many questions. And your book is fabulous. I've read half. I'll admit, confess, I've read half of it, and I read it 1 year back. So I'll just complete it because there's so many things which I've learned during the course of this interview. And if I have more questions, I'll connect with you again. Okay. So
Sure.
thank you. Thanks a lot for joining, and have a great day. And let's all make money. And as I always say, that be positive about the India story.
Yes, I'm very bullish on the India story for the next few decades. So, these short-term gyrations or short-term volatility do
Yeah.
not mean anything to me. I think, as India transitions from a 3.3 trillion economy to 5 trillion to 10 trillion and above, if you simply assume the market cap to GDP to approximate 1 over time, you
Yeah.
can just envision the kind of market cap creation and wealth creation that lies in store for investors in the great Indian businesses over the next 10, 20 years.
Yeah.
Trillions of dollars. We're talking trillions of dollars of wealth creation, which is about to take place. So this is
Yeah.
the time
True.
to think. This is the time to think big. I think in the next 20 years, the trajectory and the financial situation of many people who invest smartly is going to change completely. So this is not the time to get scared or despondent. This is the time to actually be super bullish. And all the legends of Dalal Street became legends because through all the ups and downs,
Yeah.
they had a die-hard conviction in the India story. They believed in the power of India, its entrepreneurs, and its business ecosystem. And that is what helped them stay the course. And they became legends of Dalal Street. And we should all aspire to be the
Yeah.
same.
Yeah, Rakesh Jhunjhunwala was always bullish on India. He would always say that, remain bullish on India, remain bullish on India. Okay, thanks a lot for joining us. And thank you for this interview and taking out time, it's just about your time to sleep. So thanks a lot for joining us. And looking forward to talk to you again soon, Gautam.
Thank you.
Thank you.